Hello, wherever you are, I welcome you once again to AE Accounting Tutorials. If today being your first time paying visit to my channel, kindly subscribe to the channel so that anytime I upload any new video, you get a notification on your devices. Today we are going to look at depreciation of non-current assets. Is that okay? But before we proceed, I want you to understand the difference between capital expenditure and revenue expenditure. The capital expenditure are those expenditure incurred on the acquisition or improving upon the value of non-current assets, whereas the revenue expenditure are those expenditure incurred on the maintenance of the value of non-current assets. So basically that is the difference between a capital expenditure and revenue expenditure. Now let's go to the topic for the day, that is depreciation of non-current assets. All right, non-current assets. I'll be classifying, or I'll break them into two. That is the tangible non-current assets and the intangible non-current assets. All right, so when the tangible non-current asset loses its value, we call it depreciation. So we are going to, so from the definition of depreciation is the systematic allocation of the depreciable value of tangible non-current asset over its estimated useful life. So when the tangible non-current asset is losing value, we say that is depreciation. So the systematic allocation of the depreciable value of the tangible non-current asset over its estimated useful life. So when this occurs, we say it is a depreciation. So when the tangible non-current asset is losing value, we said it is depreciation. So this is what we are going to look at, the depreciation itself. But when the intangible non-current asset is also losing value, we rather call it amortization. Amortization. All right, we call it amortization. So we will define amortization as the systematic allocation of the depreciable value of intangible non-current assets over its estimated useful life. When I said estimated useful life, that is the year that we expect the asset to be in operation. Is that okay? The tangible non-current assets are the property, plants, and equipment. Is that okay? The property, plant, and equipment, that is the PP. But the intangible assets, when it's when the value decreases, we call it amortization. And then there are the goodwill, the patents, and other intangible non-current assets. All right, so basically this is how the tangible and the intangible non-current asset works. But our focus today is going to be on the tangible one, which is the depreciation. We are not going to talk about the intangible, but I just want you to know the difference. Is that okay? For depreciation, we have so many theoretical aspects of it, but I'm not going to talk much about the theoretical aspect. Okay, I will only highlight on certain things, and after that we look at the methods of calculating depreciation. Then we take a practice question and try to solve and understand how the methods of depreciation work. But before that, let's actually look at some of the reasons why we actually provide for depreciation in our businesses. Is that okay? So let's actually look at the reasons for depreciation. All right, so for the first reason I would like to talk about is the first reason I would like to talk about that to spread the cost of the asset over its estimated useful life. That is one of the reasons why we provide for depreciation. We provide for depreciation in order to spread the cost of the tangible non-current asset over its estimated useful life. Is that okay? So let's assume that an asset is cost an amount of $10,000, and then its estimated useful life is 10 years. It's 10 years. Is that okay? So we need to spread this 10,000 over its estimated useful life, and that is going to be the $10,000 over 10 years. That is going to give us $1,000. Is that okay? So this is how we spread the cost of the asset over its estimated useful life. And I also like to talk about other reason why we provide for depreciation. Another reason is that, but mind you, there are certain accounting concepts that actually talks about the reason why we actually make provision for depreciation. One is the prudence concept. I talk about to spread. Is that okay? The first one is to spread. That is to spread the cost of the asset over its estimated useful life. And the second one is from the prudence. The prudence concept. Is that okay? From the prudent concept, it says that profit will be overstated if depreciation is not charged against income during the financial year. Okay, so when we didn't charge depreciation against income during the year, we will overstate our profits. So because of that, we need to actually account for depreciation. Is that okay? And also, we have another principle, which is the matching concept. The matching concept. Okay, the accounting standard requires that depreciation is an expense, so it has to be matched against revenue incurred for a particular period of time. When I talk of the particular period of time, I'm talking about the financial year, one financial year. So a depreciation for a particular year needs to be matched against revenue, because depreciation is an expense. So these are some of the reasons why we actually make provision for depreciation in our businesses. As I told you earlier on, I'm not much interested on the theoretical aspects of the depreciation. All right. So let's first also look at some of the factors we consider before we actually calculate our depreciation. So let's consider factors. Factors to consider. That's the factors to consider when calculating depreciation. One, we have to consider the cost. The cost of the assets. Alright. The cost at which we acquire the assets have to be taken into consideration before we calculate depreciation. Is that okay? And two, we have to actually consider the estimated useful life of the assets. We have to also consider the estimated useful life of the asset. When I talk of estimated useful life, I'm actually talking about the year or the number of years we think the assets will be into operation. Is that okay? So we have to actually factor all those things before we calculate depreciation. And the third one I would like to talk about is the estimated scrap value. Scrap value of the assets. Is that okay? When I talk of the scrap value, it is the amount that we think we can actually dispose of our assets after it is being used in the business. So when we expect to use the asset for 5 years, after using the asset for 5 years and we've actually taken all the depreciation from the asset, the amount that we think we'll be able to dispose of the asset is the scrap value or residual value. Or residual value. The scrap value is the same as the residual value. 4. We have to actually also consider the methods of depreciation. We have to consider methods of depreciation. we have several methods of calculating depreciation. So anytime you wanted to make provision for depreciation, you have to actually think of which method you should adopt in calculating your depreciation. So these are some of the factors you need to consider before you actually make a provision for depreciation. Because we are going to consider the factors in calculating our depreciation, let's now also look at the methods of depreciation, methods of calculating depreciation. So methods of calculating depreciation. I told you my focus here is to let you understand the various methods of calculating depreciation. Then we take a practice question, then we try to solve it to actually materialize what I'm actually talking about. So with the methods, we have several methods of calculating depreciation, but I will be highlighting on about 4 different methods of calculating. So first, I'll talk about the straight line method. The straight line method, or fixed installment. Fixed installment method. All right. This is one of the methods of calculating depreciation, and under this method, the depreciation is calculated on the cost of the asset, and the depreciation is fixed throughout the useful life of the asset. So when the asset is going to be in the business for about 5 years, and let's say the cost of the asset is $1,000, and we are to calculate 10% on depreciation. All right. So that is $1,000. For first year, the depreciation is going to be 100. So first year depreciation will be 100. So in subsequent year or second year, the depreciation will still be 100. The rate of depreciation is fixed because it is a straight line method or fixed installment. Is that okay? The depreciation doesn't vary. You only calculate the rate on the cost of the asset. So basically, this is how we calculate a straight line method. But there is a formula for calculating the straight line method depreciation. Is that okay? So we use it to determine the annual depreciation cost. So the annual depreciation cost of the assets, that is the cost. When I say cost, I'm talking about the cost of the assets over the scrap value. The scrap value over estimated useful life. Okay, so this is the formula for calculating depreciation using a straight line method. Is that okay? So when you talk of the cost at which you actually purchase the asset, the scrap value is the value you think you may dispose of the asset after it is being used in the business. And the estimated useful life, it is the number of years we think the asset will be in existence in your business. And this useful life, or the number of years is an estimation. It has been estimated. Is that okay? It is not a fixed number of years, but it is an estimate. That is what you need to understand. So let's also talk about the next method of calculating depreciation. I would like to talk about the reducing balance method, or diminishing balance method. They are all the same. Okay, under this method of calculating depreciation, we calculate the depreciation on the cost of the asset for the first year, and after that, the rest of the years, the depreciation will be calculated on the net book value. When I talk of the net book value, I'm actually talking about the carrying amount. That is where the accumulated depreciation is being taken from the cost then we arrive at our net book value, then we calculate the depreciation on it. So under this method, what I'm saying is that for the first year, we calculate the depreciation on the cost of the assets. After that, or in subsequent years, then we begin to calculate the depreciation on the net book value. Under this method, the depreciation keeps diminishing, it keeps reducing, as well as the cost also keep reducing as the year keeps moving. Is that okay? So for a reducing balance method, for first year, for year one, we calculate the depreciation on the cost. So after year one, that is from year 2 going, we calculate the depreciation on the net book value. So because we are calculating the depreciation on the net book value, the depreciation keeps diminishing, it keeps reducing, and the cost also keep reducing. Is that okay? But sometimes they may not give you the rate to calculate your depreciation. You may see a question where the rate to calculate or the percentage to calculate your depreciation is not given. You need to find the percentage yourself, and there is a formula to do that. To calculate the rate of depreciation yourself, that is the rate. To calculate the rate, that is the percentage. The formula is 1 minus the nth s minus c times 100. We are multiplying the formula by 100 because we are calculating for the percentage, the rate. And this one here is constant. And the n here is the number of years or the estimated useful life of the asset. That is the number of years you think the asset will be into operation. And the s here is the scrap value of the asset or the residual value. And the c is the cost of the asset. Is that okay? So let's assume that you have an asset which costs you, an asset that costs, this is in dollars, $10,000. We have a residual value. That is the same as the scrap value, being maybe 1,296. Then we have the useful life. The useful life of the asset, which is estimated being maybe 4 years. And you are to determine the rate of percentage. It is very simple. Just substitute the information into the formula to know the rate. By so doing, the 1 is constant, and the n is the number of years, which is 4. Okay, so which is 4, and we have the scrap value being 1,296, and the cost of the asset being 10,000, multiplied by 100. When you punch this into your calculator, you are arriving at 40%. Is that okay? So this is how we calculate the rate of depreciation ourselves. Okay. So let's also consider the third method of calculating depreciation. With the third method, I would like to talk about the sum of year. Sum of years digit method. With the sum of years digit method, I would say it is just a modification of the reducing balance method. Here, we calculate the depreciation based on the digits. Is that okay? And the depreciation also keeps diminishing. And we assume that the first year of the asset being into operation attracts the higher depreciation, and it keeps diminishing till the assets finally being disposed of from the business. So what I'm trying to say is that when we have an asset and it's supposed to be in the business for let's say I may say maybe 5 years. Is that okay? So for 5 years, this is the number of years. You have year 1, year 2, year 3, year 4, year 5. Is that okay? So we are going to consider the digits to calculate the depreciation. So this will be the digits. The digits. For the digits, we are going to turn the year down. to assume that the the first year attracts the highest depreciation. Is that okay? So let's say it is for 5 years, and we'll be having here to be 5, 4, 3, 2, and 1. So the sum of this, so this is 5, this plus this is also 5, this plus this 5, so 15. This is the total sum of digits. So if the cost of the asset is, let's say, how will I say, the cost of the assets is, let's say, $200,000. $200,000. So this is the calculation or the depreciation. To determine the depreciation, what we do is that we pick the first digit, which is the year 1. So 5 out of 15, you multiply it by the cost of the asset. Is that okay? The next one will be 4 out of 15, you multiply it by the cost of the asset. Are you actually getting the concept? With this one, the first one, you are going to get something like $6.67. When you use this for with your calculator, you are going to get something like that. And with the second one, you will get 533.33 when you use your calculator. Is that okay? So you can see that the depreciation keeps reducing, it keeps diminishing. Is that okay? So basically, this is how we calculate the depreciation using the sum of year digits, and it also has a formula. So let me give the formula for calculating this. Is that okay? And the formula for calculating this is that is the annual depreciation cost. It is going to be the life of the asset. When I talk about the life of the asset, I'm talking about the estimated useful life. So the useful life multiplied by the depreciable, so the depreciable amount or the depreciable value. When I talk about the depreciable value, I'm actually talking about the cost of the asset. Is that okay? Then you divide it by the sum of years digits. Sum of years digits. Sum of years digits. So basically, this is how we calculate the sum of years digits. Okay. So let me talk about the last method I would like to talk about, which is the revaluation rather. The revaluation method. The last method I would like to talk about is the revaluation method. And with the revaluation method, we calculate the depreciation based on the opening balance of the asset and the closing balance of the asset. If in 2020, 1st January 2020, we acquired an asset of $1,000, that is 1st January 2020. Then on 31st December 2020, we valued this same asset and we had $700. This is the opening balance of the asset, the closing balance. So the difference between the opening balance and the closing balance of the asset, it is what we call depreciation. So when the asset decreases in value, the difference here is $300. So this $300 is the annual depreciation for this year, as far as this asset is concerned. But there are situations where the asset value will rather increase. Maybe there is 1,000 at the beginning, at the close maybe 1,500. The difference of 500 is an appreciation, but here we are talking about depreciation. Is that okay? So basically, this is the methods. And we also have production methods too. My focus is going to be on this form. But for depreciation question, they're based on the straight line method and the reducing balance method mostly. So I want us to take a question that will help us actually materialize what we've learned so far. So I would like us to take a question and see how we can solve this question. Good man bought a motor vehicle which has an estimated useful life of 5 years for $220,000. It is expected that it will also have a residual value of $20,000 after 5 years of use. You are required to calculate the depreciation charges under the following methods of depreciation over the first 2 years. A. Straight line method. B. Diminishing balance method, assuming that the rate is twice that of the straight line method. C. Sum of years decades method. So we are going to use 3 different methods to calculate the depreciation for 2 good years. Is that okay? So the first method we are to use is the straight line method. That is the A part. So that is straight line method. Straight line method. Straight line method of calculating depreciation. Is that okay? And before we try to calculate the depreciation, let's see the formula for the annual depreciation itself. So the annual depreciation cost is the cost of the asset minus the scrap value over the useful life or estimated useful life. Okay, this is very simple, and the cost of the asset is $220,000, and the scrap value from the question is $20,000, and the useful life of the asset is 5 years. Is that okay? And this is going to give us $40,000. Is that okay? So I told you that for the straight line method, the depreciation is fixed throughout the year. So for year 1, they said we should calculate the depreciation for 2 good years. Is that okay? So year 1, the depreciation will be $40,000. For year 2, it will still be $40,000 because the depreciation will be fixed throughout the number of years the asset will be into existence. So if it is 5 years, we will still repeat it, but we are required to calculate for the first 2 years. Is that okay? So let's also look at the B part is saying that we should calculate depreciation using the diminishing balance method, assuming that the rate is twice that of the straight line method. You have to take note, assuming that the rate is twice that of the straight line method. So the B part, we have to calculate the diminishing balance method. Is that okay? The diminishing balance method. But they are telling us that assuming that the rate is twice that of the straight line method, you can even use the formula to determine the rate. But they are saying that the rate is twice. So to determine the rate of this depreciation, the rate is in percentage. So that is 100 out of the number of years the asset is being in the business or will be in the business. The estimated useful life, which is 5 years. And it is going to give us 20% for the straight line method. And they are telling us that the diminishing balance method is twice. So you multiply this by 2. That will give us 40%. So you are going to use the 40% to calculate the depreciation using the diminishing balance method or the reducing balance method. So 40%. So for the reducing balance method, I told you that for the first time we calculate the depreciation on the cost of the asset. So for year 1, you'll be calculating the 40% on the cost of the asset, which is $220,000. Is that okay? And that is going to give us $88,000 for the first year. And for second year or for year 2, I told you after year 1, the subsequent years we calculate on the reducing balance method. So the 40% will be calculated on the net book value. The net book value here is taking the depreciation from the initial cost. Okay, so 220,000 minus 88,000. Is that okay? And when we take this from this, we are going to arrive at $132,000, and this is the net book value. Now we calculate the 40% on the net book value. Is that okay? And that is going to give us $52,800. So you can see that the annual depreciation keeps decreasing. So we can keep on doing this till the asset value is actually diminished. But then we are required to calculate for only 2 years. So let's also consider the C part. The C part, we were told to calculate the depreciation using the sum of years taken. So sum of years taken. Sum of years taken method. So with the sum of years taken method, they say that the asset is in the business for 5 good years. So we look at the number of years, we consider the digits. Is that okay? Then we consider the depreciation itself. Okay, so year 1, year 2, 3, 4, and 5. Is that okay? So let's consider the digits. The digits, we are going to turn the number of years. So we have 5, 4, 3, 2, and 1. And the total digits here is 15. So to determine the first year's depreciation, that is the first year annual depreciation, what we do is that we take the 5. That is 5 out of the digit, which is 15. We multiply it by the cost of the asset. Is that okay? So the cost of the asset, that is after taking the residual value, that will give us 200,000. Is that okay? To give us 200,000, and this is going to give us $6,666.67. Is that okay? And the second year, what is this? We also do same thing by 4 out of 15. 4 out of 15. Is that okay? Then we multiply it by the 200,000. Is that okay? And it is going to give us, it is in dollars, $5,333.33. Is that okay? That is for the second year. So we can keep doing for the rest of the years. Then we are required to calculate for only 2 years. Is that okay? So basically, these are some of the methods, or this is how we calculate depreciation using these 3 methods. In our next video, we are going to take a complex question where you will be asked to prepare the asset account, the provision for depreciation account, the asset disposal account, probably the income statement extract and statement of financial position extract. But before that, we'll also be looking at the double entry for depreciation in our next video. Is that okay? If you haven't subscribed to this channel, make sure you subscribe to the channel. Is that okay? Until we meet, I think bye for now.